let's do it. Yeah.
Okay. Hi, everyone. Thank you for having me. I am going to go through a little bit of my story today. And ultimately, it's really about building your passive investment portfolio to quit your 9 to 5. I'm going to tell you a little bit about myself. I'm going to kind of level set on what we're going to talk about, some couple of terms that I want to make sure that you're aware of. And then we're actually going to dive in straight into my story, my portfolio allocations, and a tool that I have created specifically for passive investors to hopefully help them with the decision of investing in real estate. First, a little bit about me. My name is Prolet Miteva. I am from Bulgaria, but I have been here for more than 20 years by now. I have also been in the last 20 plus years in the corporate world, in business intelligence, engineering, and design. Throughout my corporate journey, I helped Leapfrog, Autodesk, and DocuSign bring their products to life. From investment perspective, I am currently invested in 25 plus alternative asset deals. And in my spare time, because it's not only about working and investing, I like traveling and hanging out with my husband and cats. You can see some of the pictures from my more recent travels underneath, and I'm hoping to continue adding to those pictures. I love real estate. I've always loved real estate. And now that I'm no longer in the corporate world, and investing full time, I have also founded a company called Wealth Cindy. It's more about building tools for passive investors, which is a little bit more of my spare time, not my full-time job. Now, before we dive into my portfolio allocation and all of that other stuff, I want to dive into two particular terms to ensure that everyone is aware and knows what they mean. So the first one is FIRE, or financial independence, retire early. So what I consider myself fired, but the RE, which is the retire early, is in parentheses because it's not necessarily for you to retire. The bigger part is becoming financially independent. So you basically have the option, if you don't want to not to work, or the option to work on what you love instead of on what you have to. So from financial independence perspective, I wasn't sure if any of you are familiar with this. And by the way, if at any point you have any questions, you can stop and ask. If I have slides, I'll let you know that I'll answer it later. But either way, I'm happy to answer questions at any time. I'm not going to be monitoring the chat. So Sophie, if you can monitor that, if people ask questions, you can ask them. Yeah. But so financial independence, there are basically 4 levels of what people call financial independence. And they are lean, FIRE. FIRE is kind of the regular one, chubby, and fat. And they all are defined by how much money you are going to live on per year. Now, this is very personal. It's all about what are your expenses and really how much money do you really need to live on. So lean is you live on 40K, and that actually means you have $1 million invested. Now, this comes from something that's called the 4% rule, which basically means that if you are depleting your portfolio at 4% per year, in theory, you should still manage to survive on that portfolio, and it should grow and should not be depleted to zero safely for at least 30 years. And the certainty of that is very high. Now, FIRE is 40 to 100K, chubby is 100 to 200, and fat is anything 200 and above. It's totally up to you what you decide your number to be. But later on, we're going to discuss a little bit how investing in real estate can actually change some of these calculations a little bit because of your withdrawals. Now, I included in here 2 separate calculators. One seems to be the most popular one, the first one. The second one, I just recently found out, and I really like how much customizations it has. So take it, play with it, so you can find what is that FIRE number. And it will tell you also for how many years you need to save before you're FIRE, and you can move from there. Now, the second term I want to kind of quickly cover is real estate syndication. I personally invest mostly through real estate syndications. I'm going to tell you a little bit about my journey, but now I am primarily investing in syndications. Syndication is basically an entity that a bunch of people create together in order to invest in a larger asset. So you might be familiar with investing in single family home, in which case it's quite easy to go purchase a property and then go with it. But if you want to buy an apartment building, it requires a lot more funds. So if you're talking about 10, 20, 30 and above million purchase prices, your down payment is higher. And unless you actually have a lot of money, which is great if you do, and even then I will talk a little about diversification later, but putting money together and purchasing a larger asset allows you to kind of participate in a more diversified deals. Now, the difference between a real estate syndication and what you would hear as joint venture is that in a syndication, you have two sides. One is the limited partner. That's me. I always do limited partner. And then you have the sponsor or the general partner. The sponsor and the general partner is actually the group that goes, finds the property, purchases the property, raises the money, deals with it while it's on operation. They deal with everything. Now, the best part about being a limited partner is that you don't really have to do anything. After you invest and after you evaluate your investment, it's pretty much a little bit a very high level monitoring and getting information from your sponsor. But for me, it's I give money to sponsors and I like to get money back. That's limited partner. So I wanted to kind of level set on syndications because sometimes it's not a term that people know. And I will say a lot of times syndication during this presentation. Now, let's dive in. First, a little bit about my story. So I started like really not necessarily investing, but I bought my first single family home in 2004. That was my primary residence. And for me, it was very interesting of a process, but also as an asset class. And I started doing a lot of research. And back in those days, there was not necessarily that much information. The biggest thing at that point was Bigger Pockets. There was not really that many podcasts. There was not like really that much out there. So I was on Bigger Pockets and I decided to buy 2 more single family homes, which I bought in around 2010. The first one I bought was specifically for an investment and it cash flowed. I got tenants, it was fine. And I was getting money. Like I was actually making cash flow, which it's certain times, like right now, it might be a little hard, but at that point I was having cash flow and I was like, this is great. My plan is to buy X number of single family homes, rent them out at $100 to $200 a door after expenses. That's my passive income and I can live on them and it will be great. Yes, Sophie?
So are these houses in California, right?
Yes, that was when I was still in California. All of this is in California.
So you say that you have a house, you live in there, and then you buy a rental and you see cash flow and you're like, this is great.
Yes, this is great. This is the way.
Okay.
Until I started kind of evaluating, oh, I have to buy X number of houses. I think it was like a lot. It was like 40 or 50 doors or something like that, which doesn't necessarily mean that it has to be 40 houses, but I was already planning for duplexes, fourplexes. And then I ran across that idea of buying an apartment complex. And I learned about syndications. And again, back in those days, there was nothing out there. There was no books. Nobody was really talking about the concept of buying apartment buildings, the concept of being part of a team, kind of really raising money. That was not there. But the moment I learned about syndications, the first thing in my mind was like, oh my God, who in their right mind is going to go and invest in single family homes when you can go and invest in larger assets and like in a way limit your risk because it's not a single family home. Yeah, everything is valued based on the money you make, not on whoever decided to sell their house next door. So I started doing a lot more research, but unfortunately, yes.
I have a question. So,
Yeah.
for our audience, would you explain like how apartments is getting priced at what way you can the price of apartment instead of price of a normal single family house?
Yeah. So the biggest difference between the single family house and a larger, basically anything that's 5 units and above, is that single family homes are really priced based on market. And obviously when the market grows, because a lot of people are looking for housing, single family homes also grow in prices. And just because the prices go up doesn't necessarily mean that your rent will go up, especially in high price states like California, Austin. No, it's not a state, but Austin, like it's very, very, very hard to find something that will actually cash flow. Nobody really cares how much rent you can make. Everyone cares how much money they can get on the market. Now, when you go into apartment complexes, everything is valued on net operating income. And the net operating income is basically your income that you get after all the expenses, except your debt service. So the way they're valued is really based on how much money does it make. And then there is another variable, which is basically called the cap rate or capitalization rate, which is a little bit more what the market can bear. But usually you're still talking about, you have to make money in order to be able to sell the building. So if the building doesn't have or has a negative net operating income, you would never be able to basically sell it. You still need to make money. It's investment and it's valued based on the money that the building makes. That's where one of the good things is that in theory, as the market or the rents go up and down and the market fluctuates, the pricing also fluctuates, but not to the extent of, hey, this is going to cost more than the rent that you're going to get. Does it make sense?
Yep. That's awesome. Any question here? Okay, I see a thumbs up. Cool.
Okay. So about 2014, 2015 is when I learned about syndication and I started planning. The only thing I'm really sorry about is that, again, there was not as much education there and I didn't really dive in deeper and learn about possibilities of investing in syndications when you're not an accredited investor. Do you want me to define accredited investor for people?
Yeah, so a lot of people also curious about that, right? Because me myself, I got to this country in 2011, and then like a few years after that, I also listen to Bigger Pocket podcasts like every single day, and then Facebook start to show me things about real estate, and there's Crowd Street is already there, and Crowd Street advertised some investment that I looked at that I was like, wow, the return is like 15% a year. How do I get it? I want a piece of it. And at the time I didn't buy my business yet. I have a little bit of money, and they say, okay, minimum you can invest is 50K. And then I click, and they say, oh, are you accredited? I don't even know what accredited means. And turn out I was not. So talk more about that.
Yeah, so accredited investor is basically something that has been put by the government to ensure that people are financially educated in order before to invest in some of those investments, which are kind of considered more like a private equity investments. Accredited, in order to be an accredited, you have to fit 2 requirements. Either you have 1 million net worth outside of your primary home, so you cannot count the net worth of your of your primary home as part of that network, or you must get paid 200,000 a year if you're single, or 300,000 as a couple. That makes you an accredited investor. There's a lot of investments that will be accredited only, or people will refer to it as 506C. But there is also another alternative, which is a 506B. 506B, you only have to be a sophisticated investor. And sophisticated investor doesn't necessarily have any definition, doesn't have any requirement on money. It just means that you need to be more financially aware. So there are deals out there that are 506B, which you can invest even if you're not an accredited investor. Now, those deals are usually a little bit harder to find because those sponsors cannot advertise. The 506C, or the accredited investor, these sponsors can give you ads on Facebook, they can give you ads on YouTube. I get a bunch of ads on YouTube, but those are only accredited investors. The ones that are for sophisticated investors, you have to have prior connection with the sponsor and kind of need to get on their list. But I wish I knew more about that when I first started, because I would have been much further along on my journey. Now, I became accredited in 2017, and my first investment was actually in 2018. And once I started investing in syndications, I kind of continued. And now that's the only way I invest. I still bought one other house, which is still my new primary home here in Austin, Texas. But outside of that, all of my investments are in syndications. My very first investment was in a multifamily, and a lot of my future investments are also in a multifamily. In a moment, we're actually gonna dive into a little bit more about how my assets are allocated across different asset types. In about basically now 3 years ago is when I decided to change my job. That's when I joined DocuSign. I was there for 2 years, but pretty much from the moment I joined DocuSign, I knew that I basically had 2 more years of work for me. And my plan was to kind of take the time, leave my job, and take an extended sabbatical. But the opportunity I got from DocuSign was great. Like, I loved the job, but I spent a good year and a half planning my exit, both from investment perspective, from getting my new primary home, moving to Texas. So it was a year and a half of planning. So just keep in mind that this is not like this and it just changes. It's always good to have some plan around how you're getting there. So now I love traveling and I work on Wealth Cindy in my spare time. And this is how I fill my time along with investing. Now, this is all great. Well,
so this is something that like blew my mind, because like you were able to dive into real estate, but not like immediately like go buy a rental and then buy another rental and keep doing it. But you kind of like consume all the information and find a really good way for you and kind of blend in a longer term. Like you blend your way out, you plan everything for your fire. Did you join like Reddit fire at a time, or do you have somebody that inspire you to do this, or a community like that you're joining and they will tell you, hey, syndication is the way to go, or what influenced you?
I think it was actually more of the planning side. For me, the initial rentals, it's interesting. It was more the side of like, it's like additional income. I would say that I was probably in the fire mindset before fire was a thing, because in 2010, I was thinking like, how do I make passive income so I don't really have to work? And then when fire was more of a like defined thing, yes, I started reading some of the fire things, but Interestingly, some FIRE methods will subscribe completely to the part of like, oh my God, you go and you save all of your money and you live on, the joke is lentils, rice and lentils. And a lot of people subscribe to that and they try to save as much as possible. For me, fortunately, I had a tech job, so I still had a little bit more of the flexibility of I was saving, but I also was trying to live my life, right? So it's not this crazy like, yeah, you have to live on rice and beans and lentils or whatever it is. You do have a life and you do still travel and you kind of is still safe. But for me, looking at real estate was very obvious quickly that it's a much better path to kind of getting to that point of, hey, I'm making money. I'm not just sitting there and waiting for the S&P 500 to go up. I'm actually taking a little bit more of an active, more you can control your destiny thing, right? You're taking a more active role in defining how you invest and how you get money back.
Yeah, that's
So
awesome.
yeah, it was a lot of podcasts. I love podcasts. Books, when they started showing up for syndications, I think the first book that showed up for syndication for passive investors was in 2016. A lot of bigger pockets, which I honestly have not been on bigger pockets in a while. It was great in the beginning. Now it seems to be a little bit more commercialized. But podcasts, there's so much great information, and both in just podcast form and on YouTube, but also things like this, like, right, finding other people that have the same mindset, talking with them, doing like, I don't know, this almost seems like a mini mastermind that you're doing, Sophie. So finding those like-minded individuals, I think, is important. I had a hard time finding those. I can tell you a lot of people in tech don't really think this way. And even now, I still have hard time like convincing people that I know in technology that they should go and invest in real estate. And I don't get it. I don't get it.
I think you get it. You got it.
I don't get how they don't see that they should invest in real estate.
Yeah, I'm glad. I'm glad that not so many of us. So it's not too crowded here. That's great for us.
Yeah. So let's dive into my portfolio. At a high level, this is how my current portfolio is allocated. And I'm not counting my primary home in here. I'm just counting my investments. So I am primarily in alternatives, and I'm going to dive in a little bit more on what alternatives mean for me. And I'm 42% in stock. When I started, I was basically like 95% in stock, right? Because that's a lot of how people are taught. And that's how I kind of started when I first came to the US. And I would definitely say in my home country, none of this is being taught either way. They not even the whole invest in the market. So it was still, I guess, a step forward. But realistically, after I looked into real estate, I started investing. And with time, my percentage of alternatives have grown. Now, when I say alternatives, let me tell you a little bit more of what I have invested from alternative perspective. Most of it, I mentioned, is in real estate syndications. So I'm at 72% of my investments are in syndications. I still have my, sorry, give me a second. I still have my rentals. And for this, I just counted what is my kind of like what is my value minus the balance of my mortgage. I also started dabbling in oil last year. It's like, I encourage you guys to take a look. A book I recommend, it's called Tax-Free Wealth. They talk a little bit about oil and real estate. It's a all way nice book. That's how I learned about oil, and that's what I started investing last year. I have some crypto because like you're supposed to apparently. And I have one angel investment that I have done in a technology company. So that's at a high level. Now, I'm going to dive into 5 reasons for me why I'm doing real estate syndications in particular. So first thing is, and this is hard for people that are starting initially in syndications, is realizing the better returns than the stock market. And initially, when you start investing in syndications, it's hard because you're giving this big chunk of money to somebody, and then you're hoping that you're going to get money back and you're going to start receiving it. And the first year probably is a little bit more of a nervous thing when you first start. But after you start getting distributions, it becomes, for me, a little bit more real. So you kind of start seeing the rewards. And once you actually have your first or second investment go full cycle, meaning that not only did they do the distributions, but they sold at the end, the returns are just like very, very different than what you'll get in the stock market, or at least what I am able to get in the stock market, because I was horrible at choosing single stocks. Then I moved to more broad index funds, but still the return, and you guys have seen the market, is just like up and down. The other big thing is that realistically, when you're getting distributions, you're getting the cash flow tax-free, or it's not really tax-free, it's tax deferred, but for the moment it's tax-free. So if you invested 100K and you're getting $8,000 a year of distributions, that is not really taxed. So those 8,000 you get back because you get depreciation that counts against that income. So it's offset to the future. That also moves into once your investment goes full cycle, because usually in a syndication, you'll get 60 to 70% of your actual money in return at the end when it's being sold, not as part of the distribution. The distribution is just to keep you happy a little bit during the time that you have your money somewhere, but the biggest chunk of money you will get is at the end. And it's tax advantage first because the tax rates for the gain on real estates are actually long-term capital gains. So they're lower, possibly lower than your typical tax rate. But also, if you continue investing over time with syndications, you get so much depreciation built up that it's completely possible that when your investment sells, all of that money you receive, and you receive on a tax deferred basis, meaning that you don't have to pay taxes on that money in that year. And $1 today is worth more than $1 tomorrow. So obviously it's always really good to keep in mind, not just the, oh, hey, what's my return, but also how are my taxes affected by it. Now, the fourth reason real estate syndications for me personally, although you guys might be also on a little bit more active side, for me, the part that it's passive is the biggest plus. I don't have to worry about my tenants. Like a couple of months ago in one of my rentals, I had a branch fall and break the fence and go into the neighbor's yard, break their grill. With syndications, when I'm passive, I don't have to worry about any of that. I mean, sure, yes, a hurricane passed by Florida and I'm going to get an update from the syndicator that they filed with insurance and they're working to repair it. But that's it. Really, I don't have to go and actually do something in particular. Now, the fifth part, which leads a lot to the whole point of syndications versus, hey, invest in a joint venture, is diversification. You can diversify by sponsor, projects, locations, asset types. All of those are options for you. Now, let's take an example. I have $100,000 to invest, and instead of going and buying one single family home or one quadplex or duplex, whatever it is, I take that $100,000 and I split it into chunks of 50. I mean, there are some syndicators that would also accept 25. 25 gets a little bit on the lower end, where filing your taxes become more complex. For 25,000 might not be worth it, but let's say $50,000, which is, you'll hear pretty standard from a lot of syndicators, $50,000 minimum. Now I can take $100,000 and invest in 2 separate syndications. And I can say that, hey, you know what? I want to invest in Texas and I want to invest in South Carolina. So I pick 2 separate syndications and I invest now in 2 different states, 2 different markets. I can also say like, hey, you know what? I don't want to just invest in multifamily. I'll invest in multifamily. I'll invest in storage. Now you're diversified across asset types. And further, you can say like, hey, you know what? This sponsor, I kind of know them, but I don't know if I should trust them yet. I'm going to pick them and I'm going to pick some other person. So now your risk is split in half. So even if one of the sponsors loses the money, you're only losing half. Now, from that perspective, let me show you how I have currently diversified. And by the way, in all of these, I'm not saying that that should be your allocation. That's my allocation. That's the allocation I have determined is good for me. That what works for me. I'm still always constantly working on making adjustments on where I'm investing. So this is how I'm currently allocated across real estate syndications. Now we're leaving all the other assets types out. This is just my real estate. So I am mostly in multifamily. I'm currently at 60%. I will probably go down to 50. I'm still trying to go through and do a little bit more diversification. The second biggest asset type I have is industrial. Then is kind of a sprinkling of RV, retail, medical, hospitality. I had storage. It went full cycle. I would like to get storage again. But this is on a high level how I am currently allocated for the ones that I'm active in. Sorry, I'm passively active in. So great, all in theory, like real estate is great, distribution great, but what happens when you actually go full cycle? And I'm going to show you guys the results for the 7 full cycle syndications that I have gone through, but I want to warn on 2 things. First of all, my syndications went full cycle last year, right before the interest rates start going up. Great time to sell. You'll see they performed amazing. Going forward, I will not assume that those will be my returns. And I'm going to talk a little bit about what my assumptions are for returns going forward. But so let's look at, so 7 full cycle deals. That was that I've had from the beginning. I had a total of 1.95 multiple. So that's about 2x, basically rounded, on the money that I've invested. And my average length of each of those syndications was 2.8 years. But I put my maximum and my minimum, mainly so you guys understand that all of this varies. And it varies on the market, it varies on the business plan, it varies on the syndicator. But my longest deal was 4 years, and my shortest deal within that time frame was 1.2 years. They pretty much kind of like flipped it.
Right. Would you say that you were investing in a really prime time of this asset class? Are these full circle deals? Are multifamily? Are they? Oh, you say there's storage. Because normally all of these syndication, they like, like typically 2 times, and the average length is they saying 5 years. And here you are with 2.8 years, which is way shorter for the same amount of like multiple. So it's great. It's compared to the normal one, it's like a great portfolio. Like you either like really actually choosing really carefully your syndicators, the investment that you're choosing, it's like making you a really good return. Would you go more into that? Would this be normal? Is it the high peak of the market or something?
That's why I prefaced it with like, I wouldn't assume that this is for the future, because yes, it was an amazing time to invest. And I know that even in 2015, 17, 18, everyone was saying, oh my God, the crash is coming, and the crash never came. So this this like 10 years of basically real estate growth was unprecedented overall. So it was amazing time to invest. And yes, that's why I do not assume this now. I do assume still that I should get my money doubled in 5 years. So, and in the two slides, we're going to talk a little bit more about that, about my assumptions for the future, but it is that doubling in 5 years. It's actually more like between 5 and 7. And I think that everyone right now is being cautious and saying between 5 and 7. But I think that everyone is just hoping that rates stabilize, that inflation stabilizes, kind of market stabilizes. If the market stabilizes, 2x is normal in 5 years. With unstable market, it's not as easy.
Awesome. So our attendee, I want to ask everyone here who want to have their money double in 3 years. This is not.
Of course I do.
You do. Okay. This is not too good to be true. This is somebody's portfolio. This is a real number from one person. So
let me share the other numbers. Let me share the other numbers, because I think that like that's where you can talk about like overperforming and underperforming. Yeah. So those 7 deals, basically now if we flip them into, those are metrics you'll hear a lot when you're getting offerings: IRR, AAR, and your cash flow, like basically cash on cash. So my deals end up with a combined IRR of 28%, which is amazing, right? That's really, really high. Usually now I would expect that to be more between 16 and 18%. And if you guys kind of look at basically doubling your money in 5 years, that is basically 16 to 18% IRR. They also did 24% AAR, which is annual average return, average annual return. But I also put my maximum and minimum, so you guys can see that not all of them did amazing. Though I had one that like did really, really amazing, which did 48% annual average return. But then I also had one investment that was 1%. And for that one, I'm just really happy and excited that I did not lose any money. So this, again, what I'm showing here is in an awesome market, awesome investments. Now it's getting harder. I also put in my year 1 stabilized cash flow, which was 5%. Right now, it's often hard to get to 5% in year 1. Usually that's in year 2 or 3. But kind of just to point out that at that time, that cash flow was a little bit easier. Now, what does this actually mean to you? I mean, this is all great. This was my performance. This is my portfolio. But diving into how can you calculate what does it mean for you when you're investing? So, oh, my highlights are on screen. This is for the second part of the slide. So first, we're going to assume that you have, you're investing $100,000. Your annual distribution is 5%, which is pretty conservative. A lot of people try to get to 7% right now, but year 1, you'll probably get 4 to 5. Projected length is 5 years with a multiple of 2. So this for me would be a good deal to find right now, especially if you're talking about multifamily. There are some asset classes that offer slightly different returns, but multifamily, I would probably not even look at the deal unless it offers me that, right? It has to have that value add and moving forward. Now, the other thing I'm assuming here is that you're in your wealth building stage and you are taking all the distributions that you're getting from those investments and you're reinvesting it in another syndication. But because, as we talked earlier, syndications usually have a minimum of $25,000 or $50,000 of investment, you are holding the money until you reinvest. And this is actually the tool that I have created as part of my side project. And you can play with it in real time if you want, but I'm going to show you what the results show. So with those assumptions, and I think the only other assumption I have is that you actually also, each year you add $10,000 to be invested. So you started with 100 and each year you add 10. Let's look at what this looks like in 15 years. Because a lot of people think $100,000 is not much, but this is what it can mean to you if you invest in real estate syndications. And Sophie, you have a question.
Okay. So the assumption here is I have 100K right now, and I'm
Yes.
gonna buy a few syndication to put my money in, right?
Yeah.
And whatever they give me for the distribution per year, I'm gonna keep it and set it on the side so I
Mhm.
can reinvest when I got enough 25K, right?
Correct.
And then every year I will save up like $10,000 to add on to, I don't know, $15,000 of distribution, and then make it into one more syndication deal,
Yes.
right? This is the assumption. I
And
think everyone here can do that. Like, it's duh. Like, normal people can do this, right? As long as they have a full-time job.
that's why I decided to create a calculator, because oftentimes people have hard time imagining this. People have hard time imagining the compounding effect. And interestingly, and we can go a little bit more in the visualization on the bottom, but it starts slow, but then it accelerates. Each one of these dots on here is a quarter in which you have saved enough from distributions and your additions to invest in a new syndication. So you can see kind of start slower, like one a year, and then it kind of starts bouncing all over the place, right? But ultimately, the biggest thing here is that in 15 years, you would basically have, at the end of that, 1.2 million of funds that are either invested and currently working or available for you to reinvest. So actually, and there's a bunch of calculations, but it's like about $950,000 that are invested, and you're going to be getting at the end of the quarter about $270,000 as proceeds from sale that you can go and reinvest the next quarter. But the total at the end of the 15 years is about 1.2 million. You would have quarterly distributions of 11,000, almost 12,000, but basically almost $48,000 a year of just distributions that will be arriving to you. And again, those are tax deferred. So you're not going to be paying taxes on that $50,000. You would be paying taxes later down the line. In the same 15 years, because you put in 100,000 and then you put in additional 10,000 a year, you have contributed 240,000. So you grew from 240,000 to 1.2 million in 15 years. And if you are 20, 30, how many times? Oh, count the dots. 1, 2, 3, 4, 5, 6, 7, and almost 20 times.
So it's like 20 syndication that you invested in.
Yes, over time.
Okay. And then like for you, you invest in more than 20 syndication, right? So
correct.
Yeah. So
and that's over time, and it builds up. So I didn't just go and invest in 20 syndications. No, I started with 2, and then I added another 2, and then I continued to add. And I've had years where if I had sales, I have 4 syndications or more that I'm doing. But you kind of have to like rinse and repeat, right? The money you put.
Like you didn't calculate here, it's hard to put on a calculation that the amount of knowledge you have about syndication. Once you do your first deal, second deal, you learn from it. And then when you do the third deal or the 5th deal, you know way more about syndication and how to vet the deal, how to diversify, and all of this knowledge gonna make you have a better investment. Would you say it's true with you over the syndications?
Yeah, as I said, I started with multifamily only. That's all I did. And then I started diversifying. And now you can see I'm in like 7 or 8 different asset types. I am currently with 9 different sponsors. I don't know, 9 different sponsors, but yeah, you diversify. And again, that's why usually you start and you split it. So you have the diversification. Like that sponsor that returned to me 1% a year, do you think I'll invest with them again? No. So I need others. So
Gotcha.
Yeah.
Gotcha. Mhm.
The other thing I put in this calculator is this comparison to the S&P 500. And just FYI for this, I took the average return of S&P 500 over the last 30 years, which was 11.1%. Their dividend rate is about 1.6%. So by year 15, you can kind of see the gray line is the S&P 500. You are much better. With S&P 500, you'll be at 824,000. And that's assuming that the market didn't go down.
Okay. And I see here in 4 years, you kind of like match the ray line, right? Like you invest or 5
Yeah.
years, right? You kind of match the ray line, but you
Yeah,
start
and
low.
you start slow. And the biggest part here in the first, I would say 5 years or your
Mhm.
first deal is that you, in a way, don't see how your deal grows until it sells. This is the sell here. This is when your first $100,000 that you invested sold. That's why you have this kind of high bump in it. And this is where you start kind of out overperforming. And you can see another big bump here because all this invested money here, you got back on sale and you're reinvested. So with a 5-year cycle, it's like every 5 years you get a big bump. And you get smaller bump because here you only invested, I think it's 35,000 or 25,000 or something like that. But you get smaller bumps on the way, but then each year you have like a larger amount vesting, you get the big bumps.
Gotcha.
Now, let me cover a little bit about how can this whole concept of FIRE though change if you do real estate versus the stock market.
One second. Prolet, I think you didn't compare enough with the stock market here. So the amount that you would get from the S&P 500 if you just put in stock 100K and then every year adding on whatever dividend plus $10,000, right? And you would get way less. You get like $24,000 now. At the end of 15 years.
Yeah, 825,000 pretty much. And at that point, that dividend, because it's relevant for one of my other slides, at that point, the dividend of 1.6% is basically $13,000, $14,000 a year. And you pay taxes on that because dividends are taxable. So for me, yes, the returns is one thing, but also for me, I can have higher draw without reducing my principal. So I am getting those distributions, right? And I'm not really selling anything. In my next slide, we're going to go through an example of actually living on your investments. But with real estate, I'm already getting 5% distributions out of my invested amount. So like that's 5% return without even having to worry about what I'm getting on sale.
But it's like, can you go back to the slide before? Because this is mind blowing. If I'm 25 years old now and I have saved up $100,000 to invest, it's almost, and I keep working a job or do whatever and live on, and don't spend all my money. I can save up like 10K a year, and then I'll be a millionaire when I get to 40. Is that what it is? Yeah.
You'll be more than a millionaire because you'll bet at 1.2.
Yeah, you're more than a millionaire. And this is just your set aside, just don't do anything, because you can do active thing during that 15 years as well, right?
Yep.
So this is amazing. This is like a way to become a millionaire. Definitely for a lot of people.
Like that. How to become a millionaire with 100,000. Yeah.
I mean, I hope all of you here are gonna be millionaire in less than 15 years, right?
I hope so too.
Yeah. It's nice.
So, but from that perspective, volatility, everyone saw what happened in the market in the last 3 years, right? It has recovered some, but with the market, if the market drops by 30%, it's not like, oh, the market needs to grow by 30% in order to be at the same level. No, if you drop by 30%, the market needs to grow by 43%. So like basically almost 50% in order to get to the same level before the drop. And that's crazy, right? And yes, the market can go up and down. In some years, you can have higher and lower, but over 30 years, the average return has been 11%, 11.6, or yeah, 11%.
That's the stock market, right?
Something. Yeah, nothing. That's not to say don't invest in stock, because stocks are good for liquidity, and that's what you saw already. I am fully believe in diversification, so I am diversifying in stock. Now, we talked about your wealth building stage. Now I'm going to give you an example of what it's like to live off that, because so I am at that stage. I'm living off of my investments. I'm in my FIRE category. I am basically do not have a W-2. So we're going to take the same example of 1 million invested, 5%, sorry, not same example, because now we're at that 1 million. And I didn't even go to 1.2, it's 1 million because it's easier to calculate. 1 million invested, 5% distributions, 5 years, 2x. However, we are not reinvesting our distributions, and we're not contributing extra 10,000 a year. Again, we are now living off of our investment of $1 million. Now, to create everything equal, because we want to live on 50,000, let's say, that's a little bit above lean FIRE. But we are also going to calculate this by taking the same million that we would invest in S&P 500 and withdrawing to the amount that we have, $50,000 a year. And I simplified it here. I didn't take into account taxes, because actually with syndications, you'll probably not pay taxes on that $50,000. With an S&P 500, you'll probably be paying taxes on dividends. But in year one, things look normal, right? This is end of year one, 1 million, a little bit more in S&P 500. But our distributions from syndications are at $50,000. And from S&P 500 is only about 17,000. And we need to take out from the S&P 500 $33,000 in order to equal that $50,000 to live on of. So year one, okay. Year 6, and I skip year 5 because year 5 you get this big bump of and like selling that 1 million investment. But in year 6, now you're at 1.75 million invested versus the S&P 500 of 1.42. And this is for twofold, because your real estate syndications are growing at basically 20% a year versus your S&P 500 is growing at 11% a year. But also each year we are increasing the depletion of the S&P 500 in order to match the distributions. In the year 6, our distributions are now at 87,500. So you basically 50% more than what you had when you started in year 1. Now in year 11, and I didn't go all the way to 16, but year 11, now your real estate syndications are at 3 million invested. And your S&P 500 is at only 1.75. And actually, if we continue the trend, in about year, I think 14 or 15, you start to deplete the S&P 500, and it starts actually going down faster than it's growing. Versus your distributions now in year 11, they're at 153,000 because you have 3 million invested.
Dang, I mean, so if you should get yourself to year 1, you kind of like all set.
Yeah, especially if you take
anything anymore.
Yeah, and by the way, there is this thing called, and you can dive into FIRE, but there's things, there's cost FIRE, where you no longer invest, you just let your investments grow and you work just some job, so you have benefits, because health insurance here sucks. There is, I think, cost FIRE, there is barista FIRE, where people have enough money, but they just work a job only for the benefits. And apparently, I guess coffee shops give benefits, so that's why it's barista FIRE. I don't know. But something to
give benefit.
Yeah, something to take a look at, because yes, if you're 25 and you invested at 100,000 and then 10,000, and by now you're 40, you're at 1 million invested, you can, in another 15 years, so 55, you're at 3 million investments and you haven't actually contributed anything else. This is after 100,000 plus 10,000 a year for 15 years, so about 200, from 240,000, you're going to 3 million.
So you're saying that, okay, so if somebody 25, they invested in syndication for 15 years, then now they have 1.2 million in syndication and they start to quit the job or whatever, like just do the work that minimal, they still have distribution of 50K a year to live on, probably more
Yep.
than that because they have, more than 1 million. And then from that to when they are in the 50, they have distribution of 150K
Yep.
a year to live off. And then
Yes.
that's it. Like they kind of like on set for retirement and anything. Like they already retire whenever
Yeah.
they want.
Yeah. And I mean, if you're more disciplined and you manage to contribute more than 10,000 a year, or it's exponentially grow. So at the end I have, and you can put the link to my calculator in the chat, but people can go and play with it, play with the amounts, like, go wild. It's like it updates automatically. But now this is all great. I wanted to give you three oh shit moments, right? So it might not always go the way it's supposed to. So you might have distribution pause. I currently have 3 investments that are pausing distribution, so I'm not getting distributions from them. So from that perspective, like really, if you have diversified portfolio and if I really need that money, I can go and sell my stock, right? So I have that liquidity, so I don't have to be like, oh my God, I need to go and find a job. So that's one thing. The next more severe step is capital calls. If the investment is really distressed, the sponsor might try to raise additional money. You don't have to go and pay the capital call, but it's possible that that can happen. And worst case, you might go into foreclosure and you might lose your full investment. So that's why that diversification and chunking with different sponsors and different deals is really, really important, so you can mitigate some of these. So, right, so you don't lose all of your money. And by the way, if you only have $100,000, I would not say go and invest in syndications. I would still say, ensure you have your, reserves and funds, and have kind of 6 months of expenses at least for you to be able to live off. And even then, put it in the stock market, right? Have that liquidity and invest portion of it. But you can start early, and the earlier you start, usually the better it is. As you can see, you can try it out. Try starting with 50,000 and start trying with 100,000, or contributing different amounts in the calculator, and see how the returns are changing. Now,
how often are these events happen in your, I don't know, you research on this, so how often do you think one would expect? Is it 1 in 10? Is it 1 in 100? Is it, I don't know, 1 in 50 or 1 in 5?
Well, knock on wood, I have not had any capital calls. I've had the distributions paused. I have not had any foreclosures. I know people who have lost their money. But I would say the biggest thing right now is be very, very careful who you invest with. Like in the previous market, honestly, if somebody lost money, they had to be like really, really incompetent. Now there's a lot more people losing money, and not all of them are incompetent. It's just the market is really tough, and they had adjustable mortgage rates. So right now, the biggest thing is vet your sponsor, vet your deals. Make sure that they are very conservatively underwritten. Make sure they're very conservative on all of their assumptions, so that capital calls and foreclosure thing doesn't happen. And probably the most important thing right now, which I wish that I was paying as much attention like 2 years ago, is fixed rate debt.
Mm-hmm. So
Even
I think
if interest rates,
you say a lot of these terms with, I think, new investor in syndication will not know. So I think
Oh,
big thing of this is like education, right?
Yes. So my very first thing is actually to kind of like the next steps, or what I'm leaving you with is education. So you guys are already like really diving into it because you are here and trying to learn, and you're listening to me babble for that long. But yeah, podcasts, meetups, virtual meetups, but also read. There's amazing books. This is I recommend to every single passive investor this book, The Hands-Off Investor. Brian did amazing job covering all of this. Every single term, like what you need to look out for, all of that. So that's great. The second step is play. Well, we play with my calculator. If you have any questions, feel free to ping me at any time. But play and understand not just like what syndications can do for you, but also play with the FIRE calculators and understand what is your FIRE number. What is that financial independence number? And you can have a financial independence number and retire early number, because those can be different, right? I can tell you, once I was financially independent, first of all, my job that I was working was in a way much easier, because I would usually, and I tell this to a lot of people, it's like, what are they going to do? Fire me? Okay, right? So in a way, you kind of become a little bit more secure in your job. So you don't have this like, oh my God, they're going to fire me. It's like, yeah, okay, I'm financially dependent. I can take care of myself, right? So it's always good. It's in a way, a confidence boost. And the third step is obviously invest. I wish I knew about 506B syndications, because I would have started a couple of years earlier and I would have been financially dependent earlier. So
don't wait until you become accredited to invest in syndication. That's what you mean.
Ideally, yeah, because I mean, realistically, and there are some proposed changes in the accreditation laws that are out there that can make it a little bit easier for people that are really determined of pursuing those kind of investments to invest. But I personally don't necessarily agree with the accredited investor definition, because I knew enough about money before I had my network to be able to go and say that I want to invest in something that has better returns. And I want to invest in something that's not just the stock market, and I want to diversify. And I think there is a lot of investors that are in the similar boat, but they are in the, oh my God, but I need to be accredited. So learn, get to know a lot more syndicators. The 506B deals are out there. So if you want to dip your feet, really do it. Again, ensure that you vet your syndicators, ensure that you vet the deals. But yeah, go and find deals that even if you're not accredited.
I remember like when I was in a MFIN in Houston, multifamily like networking event, they say there's almost 70% of these syndication are 506B.
Oh.
So way more 506B filing, which means like you don't need to be accredited. You just need to know me, or like kind of like a syndication.
Yeah.
But it's way more than 506C. But because we don't see the advertisement, right? But people already invest in syndication, they keep investing. So enough pool of people that know this to put money in, right?
Yeah. And something else to watch out for, which I have seen a few people do, is I have actually seen people that do syndications that start as 506B and then they get converted to 506C. I don't know what exactly how it's exactly done and how they found it that it's legal or not. But there is also that you might end up to be in a 506 deal, but the deal started at 506B because that's how they started raising money. That was my last.
I think people do that these days. So any question, guys? Any question for Prolet? First, like maybe give her some warm love that gave this amazing presentation to us, and ask her some question. I know Tahe, you has a question.
Yeah, like for syndication, I read a lot and I kind of know how amazing it is, but my biggest fear is that like giving my money into investment where I cannot control the outcome and I have to rely on the lead to run the project. And like, how can I make sure that the investment not going wrong? Like, because I have a really bad experience, like partner with like a person to do an investment, and then it turned out really bad, and I have to pursue a lawsuit against them. So for syndication, I'm kind of new here. I rather do it myself, and I have full control of the investment than giving that to someone else to lead that. So how can you do your due diligence to know which is good investment and which one is not a good one? Like, you go through which education to learn all about that for your first deal?
So, okay, I'll be completely honest. My first few deals, I would probably never do this, what I did. But I had some money. I was all excited about syndications. So I just went and I found some sponsors. Great. I talked with them. I like went through that, not nearly as in depth what I would do now, but at least I did some. There were already like, oh, questions you should ask the sponsor. Oh, like things you should view at the deals. There were some like lists out there. Brian has one in their book. I created one on my website. I started writing some educational articles too, but really, so there's two parts of what you were saying. So first of all, you've been burned, so it will be harder for you.
Yeah.
But second of all, you mentioned you were in a deal with like, sounds like more like a JV with somebody. One thing that I would say that when you're going into a syndication, you're actually going there with a team. So it's not just one person. So that for me actually makes me feel a little bit better, because it's not just one person running this whole 100-unit apartment complex. It's usually 4 or 5 people at least that all have different roles. And like you do need to kind of ensure that the syndicator ensures that they have all these roles, especially asset management, or if there's a big value at construction management, right? Those are roles that need to be there. But again, you're not investing in one person, you're actually investing in a team of people, 4 or 5 or more, which is already a little bit better. The other thing is, when you're investing in some of these larger ones, you do have other investors. So it's not just you and another person. So it's a little bit better. Can shit go wrong? Yes, it definitely can. But I wanted to address the other part of it that you mentioned, which is like, oh, I want to have control. Okay.
Yeah.
I will tell you that one of the best things that happened for me from my investment perspective, but also from my work perspective, were 2 things. First, I became a manager in my regular job, which automatically kind of pushes you to give up control. And I would probably say that when I was a young manager, I was not so great manager because I was like very controlling. I do like to have control too. But as you kind of grow as a manager, you kind of learn to let go, and you have to learn that not everything will always be perfect. Right? As long as really shit doesn't hit the fan, there are things that are not going to be great. There are things that will be less than ideal. There will always be things that people will do differently than how you would do them. And that can be very irritating, or you can try and learn to let go. But really with syndications, one of the things is that you have to learn to let go. And I said that for me, it was when I became a manager, because I had to learn to rely on my team, because otherwise I'm a team of one. With syndications, it's the same thing. I am letting go, but that's why I do my homework and interviews beforehand, so I have a little bit more of a faith. But I read all of my monthly or quarterly emails that come from the sponsors. I go to their webinars that they have usually quarterly, around like where you can go and do Q&A, you can see what other people are asking. But really, still you're kind of staying on top. But staying on top for me means like 10-minute read an email a month, or like 1 hour a quarter, instead of going and trying to figure out how to collect rent, how do you go and deal with insurance, because I don't know, there was a fire or the hurricane came, right? You have to give up that control if you want to be on the passive side, and you have to kind of learn to give up control in order to let people do their job. And the other thing I would say, if you're at all investing in the S&P 500, how do you feel like you have a control there? You have absolutely no control there either. You have even less control because those are just public companies that have their own board of directors, a bunch of other people that you don't know, haven't talked to, and you just blindly invested in the stock.
Yeah, you're right. Like the reason why I trust S&P 500 more is because I know like there's a lot more people watching them, not just me. Like you just share, like it's a team, so it's like a whole team gonna watch the lead to run the project, not just one person, not just me, right?
Yep. But that's why it's like, yeah, a team, and it's a larger asset instead of going and investing into a single one. And usually in some of these syndications, depending on the size, you might have like 100 investors or more, right? It's not just you who is kind of giving up that control.
Yeah, I want to add in a little bit, like if you invest in a fund and they buy not just one asset, let's say it's not, they buying just 150 unit in Texas, but they also buy another 200 units in Tennessee, and it's in a whole portfolio. So you inside that small syndication, you invest in 50K, but there's another like 500 investor in there that keep these people accountable. So that's the beauty of it, because it's easy to give up control when you're educated and know that you don't need to control here. Also, if you read cash flow, no, you look read Rich Dad Poor Dad, you see, right? Eventually you move up from being working for someone, become self-employed. You're still working for yourself, you're in control, but then like you own big business where other people run in the business, you just own it. Then you give up the control because you give control to the COO, whatever, and then eventually you are an investor, and the real investor, the investor that passive and just look at the investment, and other people need to perform and they don't have to do anything. So Sasha, you have a question?
Hello. Oh, sorry. Yeah, no, I don't have a question. I just wanted to say that basically, yeah, it's a question I had too, and I'm sorry that you kind of had a like a rough situation there. But I would just say that there's probably a set of questions out there that you can ask to vet the sponsors, and there are events where you can go and meet the sponsors as well. But yeah, I mean, we typically look at their track record and who they work with, and what others that have invested with them have to say about them. So, you know, we do our due diligence as well, and so we meet a lot of GPs out there and kind of form our own opinion about them, and decide whether we want to invest with them or not. And you know, so there's probably some set of standard questions that you can begin with in your due diligence.
Yeah. The book that I recommended from Brian has that. Yeah. So you can go for it, but also, I mean, honestly, there is like a bunch of lists out there, so you can just go for it and find them.
Thank you.
Any other question, guys?
Can you type in the chat the name of the book? Sorry, I missed it.
Yes, I can.
Hands-off investor.
Yeah.
Right.
Okay.
You can go back to that slide. Easy.
I know, but if I click
Oh, okay,
on,
I saw that.
yes, that I can stop sharing and I can put the links, a few links in there. But yeah. Any other questions?
Thank you, Philip. I think Dahe has a question that she asked me, but I don't know whether you want to ask here, Dahe.
I don't remember what that was. Can you ask?
I think I was about to do this webinar, and then Dahe say, "Oh, I have to go there and ask her how she makes so much money to invest in syndication."
That's right.
Yeah. So I was in tech. So in the beginning, it was like a lot of saving. I didn't start at that high of a salary. I mean, definitely later on, it helped that my salary was higher because I was in technology. But the other things that helped, honestly, were my homes, like my investment home that I bought as a rental. And I'm not saying go ahead and do that, because I would consider that I'm probably a little bit more on the adventurous and risky investor type. But I actually refinanced that house once it had grown a little bit in value. I took the money out and I invested in syndications. My old primary home, the same thing. Like, I think I refied that twice. And each time I took more money out, and like I went and I invested in syndications because it was just making more sense to me. And realistically, all of my savings, they usually went to syndications. I did have a 401k, and we haven't ventured into that, but I don't know if you guys know, but actually with your solo 401k or with your self-directed IRAs, you can also invest in syndications. So you can invest with your retirement fund. So now a lot of my retirement funds are also invested in syndications. So I know them. It works for me, so that's what I do. But it was a lot of that kind of like savings, refi of existing assets. And the other part now is that when a syndication goes full cycle, I go and I take the money and the proceeds from sale and I reinvest. So I'm in that snowball part.
So if you reinvest, is another way to reduce your tax as well, right?
Yes, as I mentioned earlier, in like really, you might have so much depreciation built up from other projects that the year that the project sells, you don't pay any income taxes. They're deferred to later on because your basically depreciation offsets your passive income. So there is definitely a lot of tax advantages.
That's awesome. I think all of you guys here make really good money. Except Sasha.
One thing to point out, like depending how good of money you make, because I saw recently a discussion and there was some misinformation, but some people think that like, oh, if I'm married, I have to make 300,000. No, it's like, as long as one person makes 200,000 or more in the last 2 years, that person is accredited. Some people incorrectly tell people that together they need to make 300,000, and so they wait. But if one person makes 200,000 and the other one doesn't make that much, that person can go and become accredited. The only restriction is when they invest, they cannot invest as a married couple. They have to invest by themselves. But if you're in a common, what's it called?
Commonwealth?
No, not Commonwealth. It's anyway, if you're in states like Texas or California, either way, everything is after marriage is divided. So it doesn't really matter if you're married, if you're investing as a married or not. But just keep that in mind. If you really are making enough money, you just need to make 200,000 in the last 2 years or 300,000.
That's easy, guys. Go make 200K more a year.
Wait, everyone does? I don't think I do.
You don't have to, but you still can invest in syndication and grow into more than 1 million easily. Any other question? Philip, any question?
I have one. where did you find your first deal? And I guess it's a two-part kind of question. Where did you find your first deal? And what are some syndication group that you recommended that you are in as well to look for deals?
Okay, I don't want to say on recording who I recommend, so I'm not gonna tell any particular recommendations. But my first deals that I found, honestly, one of the syndicators was very, very active on Bigger Pockets. They had a great podcast, but I listened to pretty much every single episode of that podcast prior to kind of going through, and just so I can feel like they knew something. The other one that my first two deals is somebody I met in a meetup when I was still in California. There was a real estate meetup, so I went to that meetup a few times. They were presenting a couple of times, so again, it was really trying to get to know them. I met them in person, like they walked me through their business plan around what is their business plan when they're to syndication. So it was really those two things that made me feel okay. And then I became a little bit more adventurous, and I actually went on CrowdStreet. So on CrowdStreet, you have to be unaccredited to invest, but CrowdStreet was great at that time. They're making some changes now, but at that time it was great to go and review stuff. Like look at what a PPM or the private placement memorandum, basically the legal documents that you sign, what they look like, what do the people promise, watch a bunch of webinars, just so you can kind of get a flavor of like, what is this all about? So you're not just going and seeing one webinar from somebody and you're like, they told me it's going to be 2x in 5 years. Yeah, so I would highly encourage you to kind of spread out webinars, podcasts, books, kind of get to know. If you have local meetups, I don't know where you guys are all from, but go to some of the local meetups, meet other people. The best way also to find good sponsors to invest with is other passive investors that are investing with those sponsors, and they can tell you like, oh yeah, I recommend this, I don't recommend this. I would usually not recommend anyone unless I've had a full cycle deal with them. So even ones that currently I might have and they're performing well, I might not recommend them or not even mention them because it's like, I don't know, right? I'm waiting. So those will be my biggest things. And I know it's hard if you have a full-time job, but if you have a full-time job, some of these virtual things now, great that there's virtual things, are really great.
Thank you for sharing.
Yeah, there's a lot of resources, right? So once you start digging to it, then you should go on the rabbit hole of, and then once you gather enough information and connection, networking, then you have confident enough, then you can start to invest.
I stopped sharing because I was going to put in the link to the calculator and to the other two fire calculators, so you guys can play with that. Philip asked, oh, did you already ask me that question or you just asked it? Since you started in real estate syndication, have you consistently been a limited partner for every investment you've made, or did you work your way up to become a general partner? Okay, Sophie knows this about me. I do not want to be a general partner. And there are people that say like, oh, I worked my way up to be a general partner. Honestly, for me, that's not working up, it's working down. Because when you're a general partner, you have responsibilities, you have a job, you have to worry about other people's money. That for me is not something that I want to do. But for me, limited partner is where I'm happy, right? This way I can go, I can invest my money, and then I can work on like Wealth Cindy, or I can go travel, and I can go travel in the middle of the woods and I don't care because like I don't have the coverage. Doesn't matter. I don't really have any responsibilities. So for me, I've always been a passive investor outside of my single family homes, but I'm not planning to do any more of those. And that's what I want to be. I want to be a limited partner. I want to do other stuff I enjoy.
So, okay, so that's the Prolet. Like, it's impressive because like first time I met Prolet was at a meetup. It's a Austin commercial real estate meetup. They meet every Tuesday lunch, every Tuesday for the past, I don't know, 7 years.
Yeah.
So everyone invests in commercial real estate there. And they say what they do when they introduce each other. And Prolet stand up and say, "Hi, Prolet, I'm a passive investor." That's it. And I feel like, oh shit, like this girl's like just judging everyone else and saying, you know, you okay, I might invest in you. You're not, maybe I'm not gonna invest in you, kind of thing, like kind of establish that authority. So that's
Yeah.
really cool. Yeah. And really be in the eye of the four quadrant of like, are you employee, are you self-employed, or are you a business owner, or are you investor? So being an investor is like the highest of them all.
Yeah, and because it is the most passive. Even a business owner, it's still more intimate. And I mean, single family homes, people say that it's passive. It's not that passive. I mean, I don't have property management on my houses. But I know that even with property managers, people always complain, what's the worst thing in every deal? Property management, and everyone just complains about their property management. So obviously it's not that passive.
Yeah, ask me more about it. As Sasha, as well as Chi, you know, as how like everyone here have rental house, and of course not passive at all. And being a general partner, I think it's a great way to 10x your money. Basically, whatever people say, as a passive investor, they can double their money in 5 years. You can 10x your money in 5 years if you are the general partner who doing the work for that 5 years, right? So basically, like a lot of that coming from working, because you take on responsibility, you take on a lot of risk because you guarantee the loan, and you're taking on a lot of like basically like a lot of trust of people trusting you with their money, with their hard-earned money. So if you're ready for that, then you should be rewarded 10x, right? And then if you do a good job making other people money, yes, duh, you should get that money, but it's a lot of work. And me and Sasha go through that part and try to be general partner and stuff, but it's not that easy, guys. It's not that easy. Like it's a huge learning curve. Like it's hard to really do it because it's gonna take you a year or two learning and keep learning and networking and try things out. So being a general partner is like you learn a new career basically, and you really do hard work for people for, I don't know, 5 years, 10 years, 15 years. And you have to deal like with 500 people with one deal that you're working on, kind of thing. So it's always a choice, and it is a path that I think very rewarding if you really love real estate and want to really, you know, deep dive into it and do it. And I strongly recommend. It's going to be really rewarding financially when you really work hard. But if not, like being passive investor is awesome. No, like Prolet.
And I would say that often it's not just one or the other. I think that pretty much every single general partner I've met, they also have invested passively somewhere. So it's not just one or the other.
Yeah. Yeah, I met, you know, like, of course, they invest in their deal, but also they make so much money, then they need to invest somewhere else. And usually they invest in syndication. They're not going to go invest in stock for sure.
Yeah.
Any other question, guys? I see Odelia here. I never met you. Can you introduce yourself, or you have any question?
I know. How are you guys? I'm Adelia. I I don't know how to introduce myself. I'm actually in New York right now. I think we have a mutual friend, which is called, which is Erna. She put me in your chat, so I got the link, but I never actually presented myself. I've been living in Spain for the last 15 years or so, and I'm back in the US now. So I'm into multifamily. I understand the wanting to be a limited partner, and that's everybody's goal, but I think my path goes through GP first. I also have a little bit of, I used to be in private banking, so I have a bit of a financial background. I don't know, I've done consulting, I've done all kinds of stuff, and I've done commercial real estate in Europe, actually, for a, what do you call it? Family office. So I've been sort of on both sides of deals, like looking for the money and investing it. And I'm trying to do the same here. I think it's a great opportunity for everybody, whether you're a GP or an LP, for the coming deals that are coming. It's not going to be the last 3 or 4 years of deals, but it's a good investment for the long term. And I think there'll be good opportunities with good operators coming up now. So that's about it. So nice to meet you all, and thank you for the lecture tonight.
Nice to meet you. Yeah, it's great that you're back to the US, and I think it's a great time to be in because the market been down, and now the upcoming deal is really good deal. That's what I heard from all these, mentors I have. And also, funny enough, Prolet's sister is also a big commercial real estate investor in Europe, right, Prolet?
Yeah, in Germany.
Yeah, she's
So we were doing it for private, for our private family office, and we did condo conversions and office. Like we had WeWork. We bought a building for WeWork. I did the first 2 leases for WeWork in Madrid. Let's not even go to what happened to WeWork, but in essence, there's a lot of stuff that it's interesting. But what the financial system here is so much better that everything that we did there should be so much easier here. And I think
I was going to ask.
everybody that's working here and trying to invest here, you guys are lucky, because it's much, much better than it is anywhere else in the world that I've seen. So anyway.
Yeah, I was going to ask how is it for you here? Because yes, I know that, like, talking with my sister, yes, like it's a very, very different situation here, very different returns in the US versus Europe. So welcome back.
Thank you.
You guys, any other questions? Any questions, Sasha? No. Yeah, I guess that's it. Thank you so much. It's like more than the time that I think it's just an hour, but it's more than an hour.
No, you were asking me too many questions. My presentation usually is shorter. It's okay. No, it's totally fine. Thank you. Thank you for having me. Hopefully it was useful for you guys. If you have any questions, feel free to ping me. Oh, I didn't put my email, but it's yeah, you can.
Yeah, you can friend with Prolet on Facebook, but she's never on Facebook anyway. So find her on LinkedIn.
Yes, find me on LinkedIn. That's much better.
Show some love to her well Cindy calculator, play with that and tell her how shitty it is. If you think it's not that great, because she's trying to improve it every single day.
If anyone has any feedback, I take feedback, and I'm not offended. I'll take any feedback.
Prolet is awesome, guys. And you guys here are awesome. Thank you so much for joining my first Facebook Live Zoom. And I hope to see you again next week when we talk about private money lending and stuff. So
thank you.
Meeting
Good
here.
night, everyone.
Yeah, and good night, everyone.
Thank you so much.
Thank you. Thank you. Good
Thank
night.
you.